All right, so today we're looking at a chart, EURUSD. This is a 4-hour chart, and I'm going to talk about a setup that I saw this morning. That setup is from ICT's 2022 mentorship, and I'm going to leave a link to that in the video description, to that entire playlist that he made, because this is straight from that playlist. Okay, this setup, this pattern is straight from that playlist that he taught last year. And so we're going to break it down because I know a lot of you that follow me, you also are interested in his content. You want to learn, kind of see like a different lens of view, or maybe hear a different perspective on his concepts, or just different examples, etc., etc. That's what we're going to do today. So this is EURUSD 4-hour chart. Now, number one, and I want you to take note in this, I want you to write this down. It's always best if the reactions, when the reactions, like your shift in market structures, your fair value gaps, it's always best if those reactions are off of higher time frame levels. Okay, so what do I mean when I say higher time frame? Well, higher time frame levels are like your 4-hour chart, daily chart, weekly charts. Okay, your order blocks, levels of support, resistance on those time frames. Okay, those levels are respected immensely. Okay, and that's where you'll get a lot of your best reactions. That's where you'll get a lot of your highest probability trades, is off of those higher time frame levels. Okay, so in this case, we have on the 4-hour chart, we have a 4-hour order block, a bearish order block. So you see right here, that's a bearish order block right there. Okay, that is our point of interest. That is our key level on the larger time frame chart. Okay, price did what? We had that large move yesterday, and then we rebalanced. We came up, rebalanced that portion of price action, and we came up this morning during London session, and we tested this bearish order block, aka our point of interest. Okay, and I'm going to mark these lows down here because this is where we want to target if we're playing the structure on this. We want to target these lows. Okay, so now let's go down to a 5-minute chart. I think the pattern happened on a 10-minute as well, but let's go down to a 5-minute chart. Okay, so you can see this morning, here is midnight right here. If you look at my cursor, and then we traded lower, and then we had this push up right here, and we pushed up. This blue line right here that you see displayed horizontally across the chart represents where the area that bearish order block on the 4-hour is. So you can see we traded up through into that 4-hour bearish order block, aka our higher time frame point of interest. And then what happened off of that 4-hour order block? Boom, you get a nice big displacement lower. Okay, and remember, what's the confirmation? What do we want to see? Well, we want to see a shift in market structure, and we need to see a fair value gap confirmation. Did we have that happen here? Well, we broke this swing low right here. See that? This first move lower, sure, it wasn't a very strong break. It was kind of shallow. The second time around, it cleared it much more with much more aggression. But still, we had a shift in market structure once it broke below this low, and we had a displacement created on that move lower. Okay, that's what you want to see. That's your confirmation. Okay, because it shows us that this level right here is being respected as a level of resistance, that bearish order block. It was respected as a level of resistance. Okay, and that's why we had that reaction off of that level. So again, what's next? Do we just go short as it comes down into this level? Do we just go short right here? That isn't ideal. Sure, you can, but if we want to minimize our risk to the best of our ability, it would be much smarter to let price retrace back up into a premium, back up into that fair value gap, right? Because once we take out this low, we have that shift in market structure, it's still bearish, but it's in a short-term discount, which means cheap. Discount means cheap. On the short term, it's cheap right there. Okay? We want it to retrace back into a premium. Premium means expensive, right? Into our fair value gap. And remember, when you have a fair value gap like this and it hasn't been tapped into yet, it's also going to serve as a draw on liquidity. So more times than not, price is going to want to retrace higher and tap into that imbalance to efficiently deliver that price action. And it does it. It comes into it, and it trades up into that imbalance right there if you look at my cursor. Okay, so did it trade up into a premium? What is a premium? It would have to be above 50% equilibrium of that price range. There's your 50% level. We We did just that. We traded above 50% equilibrium. We tapped into that imbalance. Confirmation. You're good. You can get an entry there. And you had it a little bit later right here as well. You can see on that push up higher. So let's just plot it on there. And this time around, clearly you got above 50% equilibrium, aka in a premium, and you even got 61%, which is key Fibonacci retracement. That's my favorite level in the Fibonacci, 61%. So you got it. You got your confirmation. You got a chance to get in on that fair value gap. Where would your stop be on something like this? So best place to keep a stop, high of day, right there, right above the fair value gap, right above high of day. That's where you keep your stop. And as for a PT, that's really up to you and how you want to play it, because we all have different strategies, ways of doing things. Some people like to take partials. Some people like taking everything off. No way is better than the other. It's really up to you. Okay. So like, for example, say you're a part of the crowd that likes to take everything off. No problem. Say you want to target this low because that was the absolute low of that 4 hour. And if we're playing the structure on the 4 hour chart, we would want to target this low. Okay. So that's where you want to target. So, I mean, that would be how you would play it. You would keep a stop above the fair value gap and you would target that low. Okay. Again, we identified our higher time frame point of interest. That's key. Okay. It's always best if the reactions are off of higher time frame points of interest. In this case, we had a 4 hour bearish order block. Okay, we identified it, we plotted it, we waited, and boom, you get a reaction off of that bearish order block. Okay, that reaction is key. What do we want to see on that reaction? We want to see a shift in market structure. We want to see a fair value gap. We got it. Market structure shift, fair value gap left off of our higher time frame point of interest. Next, we want to see it retrace back up into a premium, aka above 50% equilibrium. We want to see it tap right back up into that imbalance. Okay, that is your entry. That is your entry, and you really want it during a key time period as well. I want to state that as well. I want to state the importance of that. In this case, it was during London kill zone, which isn't a kill zone that I personally trade. Again, I'm breaking down this chart just for an example, just for studying purposes. I trade New York kill zone personally, which is 7 to 10, but I push it to 11 because I get a lot of opportunities. I still get a lot of opportunities in between that 10 to 11 mark. So when all of that lines up, when we have our higher time frame levels, when we have our lower time frame confirmation shift, fair value gap during a kill zone, during a key period, the higher time frame structure, we're aligned with that as well. That's a high probability trade. And let's also not forget the fact that if you were to target these lows, that's 4 to 1 risk reward. That is 4 to 1 risk reward on that trade. Okay. Think if you were to just hit one of these a month, okay, just one, literally just one trade like this a month. They say at this point your experience, say you got a lot of experience under your belt and you're risking 2%. Okay, a beginner, I don't recommend risking 2%, but if you're more experienced, you can. That's what I do. I risk 2%. One trade like this, 4 to 1, 2%. That's an 8% gain. That's an 8% gain. You do that over a 12-month period. That's 100%. That's over 100% account growth. Over 100% account growth. That achieved with one trade. One trade did that. That setup right there that you're staring at could accomplish that. And it happens. It repeats. Like these patterns, price is price. The same patterns, they repeat. They're not going anywhere. I mean, day in, day out, week in, week out, it's there. One trade like this. Now, I know there's going to be some doofus in the comments because I get them on Twitter all the time when they say, oh, but this is baloney. You're saying that all trades are going to be winners. All these trades are going to be winners. No shit, you're going to have some losers, okay? I mean, anybody with half a brain knows you're going to have losing trades, okay? But what I'm saying is it pays to take high quality trades. It pays to be patient. That's all I'm saying. All I'm saying is it doesn't take much. That's the point. Sure, you're going to have losses. That's part of trading, okay? It's part of trading. You're going to have L's. That's part of trading. We all know that, but it doesn't take much. One trade right there. That can make your month. That can make your entire month right there. Okay. Again, full transparency. I did not hit this. I'm just putting it, I'm just showing you for studying purposes. That's it. It's just for studying purposes and to bring to your awareness that these patterns, they repeat. Okay, this isn't just some one-time thing. These patterns, they repeat. They happen over and over again. Okay, the setups happen over and over again. Okay, so I'm just bringing it to your attention, and it's up to you. Again, like the setups, they're there, they work, but it's up to you to be patient. It's up to you to be patient and wait for them. Okay, and that's really what I'm trying to drill through your head with this video. That it pays, because a lot of you think you got to be in the market trading every single day. You got to be trading everything that's moving. You got to be trading, and that's just not the case. That's not the case. Like I've displayed right here, one trade would accomplish it for you. One trade. So, conclusion. What have we established? It's always best if you have a higher time frame level. Okay, so like your 4 hour, your daily, or the weekly levels off of those time frames is definitely best. And then next, you want to see a reaction off of those levels. So you can see right here, we came up into that level, we grabbed that liquidity. So that for some of the beginners that may be watching this might be thinking, oh, I thought we had to get a liquidity run. That happened right here. See how I grabbed that liquidity? And also we had the order block, obviously. So we grabbed all that liquidity, and then boom, you got that shift lower. Higher time frame level, liquidity grab, shift in market structure, fair value gap confirmation, retrace back up into a premium, back up into your fair value gap entry, stop above high day, target to lows. Just like that, boom, 4 to 1, that's your trade.